Hello, and welcome to the Baird Trust Large Cap Equity First Quarter Portfolio Recap. My name is John Watkins, and I'm a co-portfolio manager on the strategy. Jumping right into performance, the table at the top of this slide shows our performance track record. In the quarter, our portfolio declined 6.6% gross of fees and 6.9% net of fees, compared to the 4.6% decline for the S&P 500. And for the trailing one-year period, we were up 12.8% gross and 11.3% net versus a 15.7% gain for the S&P 500. So after a very strong year in 2021, where our LCE portfolio was up over 31%, outpacing the S&P 500's 28.7% gain, the script was flipped this quarter and we underperformed our benchmark. This is a great example of how unpredictable short-term performance can be and why we don't place any focus on our short-term numbers. This includes both when they're good, like last year, and when they're not as good, like today. On the bottom half of this slide, we've listed our top and bottom contributors for both Q1 and the one-year period. One I would point out on the right side for the quarter, you can see that Home Depot, which is one of our largest holdings, detracted 2 full percentage points from performance as its stock price fell 27%. Over the short term, Home Depot's stock sometimes trades up and down based on the housing cycle. And today, higher interest rates are causing fear that Home Depot's business will slow in the coming months. But the company's long-term success won't be driven by the ups and downs of the housing cycle, but on its ability to continue to delight its customers, gain market share through multiple cycles, and grow its cash flow per share. So in addition to the individual stock price performance of the companies listed here, there was one other factor that drove our underperformance in the quarter, and that is that we have no holdings in the energy sector, which was the best performing sector in the S&P 500, rising nearly 40% in the quarter. This detracted 1.2 percentage points from our relative performance. Our view is that energy companies have cash flows that are volatile and are entirely dependent on the price of a commodity that's impossible to predict accurately, which is why we don't own any in the portfolio. Over the short term, stock prices can move around based on many factors unrelated to the underlying business fundamentals and are often driven by investor emotions. But over long time periods, 5, 10, and 20 years, a company's stock price will more accurately reflect the success or failure of its underlying business. This is where our focus remains. At the end of the day, we're trying to grow your wealth at an attractive rate over many years. Over the past 25 years, there have been many short-term periods where our investment performance lagged the benchmark, but we feel strongly that our strategy is fully intact. So moving on, this slide shows our recent portfolio changes. We made no changes in the portfolio in the quarter, which is not unusual for us. Most money managers move money around, shifting their portfolios based on the news of the day to try to capture short-term trends. We're seeing a lot of this today. Our strategy is different in that we try to own businesses with consistent and growing cash flows over a period of many years, often for longer than a decade. Because of this, our trading activity is often infrequent, which results in an extremely tax-efficient portfolio. This slide shows our current sector weightings as well as our top 10 holdings at the end of the quarter. So just one quick comment on the sector weightings. We are bottom-up investors, meaning that we are looking for businesses and management teams that meet our investment criteria, regardless of what sector that they're in. All of our investment decisions are made this way and are never based on any sort of top-down sector exposure. So the weightings in this table on the left are simply a reflection of where we are currently finding the best investment opportunities. The weightings look different today than they did 5 and 10 years ago, and you can expect them to look different in the future. Finally, just a few big picture comments. The first quarter of 2022 saw a dramatic change in the equity markets. The optimism of 2021 was swiftly replaced by pessimism, which resulted in a more volatile stock market in the quarter. So while there are many underlying factors, we think that the key drivers of today's uncertainty are twofold. First is the Federal Reserve's policy shift to tackle elevated inflation. This will lead to higher interest rates and the removal of liquidity from the markets. And then second, Russia's invasion of Ukraine introduced a level of geopolitical uncertainty in the world that we haven't seen in quite some time. So we don't know precisely how the shifting Fed policy or geopolitical upheaval will impact the economy or the stock market. Fortunately, our strategy and our long-term investment success is not dependent on our ability to make these sorts of predictions. In fact, there are likely to be more surprises ahead that we aren't even contemplating today. We believe that the future is always uncertain, although there are times like today where we are reminded of this fact more often. We built this belief into our investment process, which is designed to be prepared for both the tough times, but as well as the good times before they arrive. We do this by focusing on only owning high quality businesses that have competitive advantages and great leaders and trade at compelling prices. We will stick to this time-tested process, which has been in place for over 25 years, for many more years to come. So that does it for our Q1 portfolio recap. We look forward to reporting our Q2 results to you in July. Thanks so much for your time.